Hope you enjoyed a good short break there and ready for our next session. Now, you may have noticed that there has been a pandemic for the last, well, it feels like about 25 years to me, but maybe I think it's only about 18 or 19 months. And as a consequence of that, there's been government intervention all over the world. So this session is looking at those government interventions from an international perspective and the efforts, the results of those government interventions to mitigate the economic impact of COVID-19. So I'm delighted to have with me in the studio is Phil Bourne, who's the head of UK mortgages for Ohpen. And joining us remotely, Darren Cantor, who's the Managing Director, Mortgage Advice Bureau Australia. Welcome, Darren. And Hitan Ganatra, who is the Managing Director for Visionary Finance. Welcome, gentlemen. Very pleased you can join me. How are you all?
Really good, thank you.
Well, thank you.
Good.
Wonderful, thank you.
Lovely. Okay, so just a little bit of flavour on the session. We're probably going to reflect back to the 2008 economic crisis at some point as well, or the credit crisis and then the banking crisis that followed, and then we'll touch on government interventions and consequences post-COVID. That's broadly where we're going to go. Hitan, I'm going to come to you about the UK first. Can you make a few observations about what you've seen in the UK from government, and let's have some opinions as well. What do you think they've done well and badly as well?
So I believe that the UK government reacted very quickly to the to the COVID crisis rather, and I think that probably stemmed from the fact that they had the blueprint from the financial crisis that took place in 2008. They were quick to pump liquidity into the market. They were quick to stabilise and react to the shock that took place in terms of the lockdown, etc. And I think because this particular COVID crisis was outside of the financial system, obviously there was a number of measures and learning points that were sort of taken on board from the 2008 crisis that was there. And I think we were in a much more of a safer and sounder footing when it came to the financial services sector. So in essence, I think the biggest challenges that the lenders particularly had was how to deal with remote working, which was the biggest, one of the biggest challenges that the country faced, but also the locking down of all sectors really, where the housing market effectively is, works upon a lot of fluidity and a lot of movement in terms of people being able to view houses, people being able to sort of rent freely and going to view these properties. And with lockdown in place and with the housing sector effectively shut down for that period of 6 to 8 weeks, I think that's where the real sort of, it was a learning curve. It was a learning curve, but I think from a government perspective, I think they reacted very, very well with a number of interventions that they implemented as far as mortgage holidays, rent holidays, etc. So I think as they did the best they possibly could, given that obviously we've never seen anything like this as an economy or worldwide economy in the past.
Thanks, Hitan. Phil, I'm going to come to you. You've Phil Ohpen, domiciled in the Netherlands, but now in the UK with a big launch. So congratulations on that.
Thank you for that.
You've built knowledge in the Netherlands and Belgium. Do you want to just give us a flavour about what you've learned?
Absolutely. I think the first thing to say is that it's worthwhile noting the similarities between the Dutch, the Belgian markets and the UK. Very much broker-centric with similar mixes of products. So perhaps it's not that surprising to say that a lot of the government interventions have been very similar too. The payment holidays, as Hitan's already mentioned, and of course the sort of loans for small businesses and those sort of things, coupled with the remote working and the changes to make the payment holidays work within the banks have been really challenging. And I think we're only starting to see some of the fallout from that now. And I think we'll come on later, won't we, to how the market's going to change going forward. But for me, they are the two key areas.
Sure. Okay. And Australia. So Darren, Australia's dealt with the pandemic in a medical and epidemiological way slightly differently to Europe, but what have you seen about government intervention in Australia?
Yeah, to echo Hitton's thoughts. So we had probably the luxury to a point whereby what we were seeing overseas, we had probably a month delay on before it hit Australia. So we're able to watch and observe some of the learnings from overseas. So whilst a lot of governments were making policy on the run, Australia at least had the ability to be able to watch and observe some things that may or may not have worked quite well. What we probably were surprised here was the level of support the government threw at the problem. I think we were lucky, maybe luckier than other countries, where the government's balance sheet was in a fairly strong position. So they were able to throw a lot of money at various industries to prop up and support the economy. And whilst we didn't avoid a recession, Australia hadn't been in a recession for near on 30 years. So where the rest of the world through 2008 had huge troubles, largely we survived that unscathed. But this time we didn't. So it's the first time, as I said, 30 years where we didn't have we had a recession, and that scared a lot of people because unless you were, dare I say, less than 50 years old, you hadn't lived or worked through a recession. So there was a lot of instability with the country. There was fear. I think what's been surprising for us is the level of fear that Australia has had towards this. So the government it's been well received that what they did put in place actually really supercharged, and what we have had across the board over last year has been an economy that's actually, despite everything ahead of it, has boomed since that recession we had. So we've had the repayment holidays in place. We've had JobKeeper, job seekers, all things to keep people gainfully employed or at least paying their bills. And largely that has stabilised where we're at. But I think the key for us is the next 6 months. What does that mean now that support levels are lessening? I think the key for us the next 6 months or 12 months, what will that really look like? Because what we're seeing right now, I think we could argue is probably a little bit artificial in its nature. And that'll be interesting to see what comes next.
Yeah, I think one of the presentations we saw earlier today showed that there was a much softer shape in the damage inflicted than expected. But well, in the UK at least, stamp duty relief ends in less than about a week's time. So go on, let's have a chat. Phil, I'm going to put you on the spot. Get the crystal ball out and tell us what's going to happen.
From my perspective, I think as the stamp duty holiday finally ends, I think we'll see a slowdown in the housing market and hence applications for new mortgages for home building. Obviously, the remortgage stuff is still going to be there, and I suspect that coming into the new year, we'll start to see levels picking up again. I mean, I think historically we've seen these stamp duty holidays and other government incentives. We get a dip, but then we recover quite quickly. So maybe 3 months, maybe 6 months, I suspect we'll be back to levels that we saw. The housing market recovers as it does, March, April time. I suspect we'll be back to normal volumes.
What's stamp duty in Holland and in what they call it, the Low Countries is the collective name. So we're going to refer to it now, aren't we? What's been forgive me for not knowing when that started and ended in this.
There haven't been sort of similar things around stamp duty, but a lot of the government taxes have been changed, or as in the UK, deferment of tax payments and things like that. So it's probably had a very similar effect to the UK. And as we come out of this, I think people will then be either paying off arrears for some of the loans and whatever, and that will be factored into people's balance sheets and people's P&Ls going forward. So certainly lending to small businesses, whether they're corporate buy-to-let or whatever, is going to become a lot more complicated from an underwriting perspective. But I think that's just one of the areas that we're going to be looking forward into the next year. I suspect the same in Australia as well.
Yeah, Darren, I was going to come to you on that as well. Stamp duty, or the equivalent of in Australia. What's the picture been like, and looking forward, what do you expect to see?
Yeah, stamp duty, the concessions put in place from a stamp duty perspective were only for first home buyers. So what we saw, the government saw an opportunity to essentially try and solve two problems: boost construction by putting stamp duty concessions for newly built properties for first home buyers, and the second piece of that obviously is to get first home buyers into the market, because our property prices here are so high, with an average median house price of over $1 million nationally, and where I live in Sydney at almost 1.5 million, which is that's tough for a first home buyer to get into. So stamp duty across the broader market was untouched. So what's happened is the first home buyers, all those incentives were put in place. What it really did, it was just inflated some of the prices. Our firm particularly works with a lot of builders and land developers, and the moment they changed the thresholds, lo and behold, the land prices went up by the equivalent of that threshold. So it really didn't solve anything, to be honest. It actually made the barrier to entry somewhat higher. So whilst those stamp duty concessions are about to come off, a lot of the industry participants are actually hoping they do, because it hopefully should stop that that demand that's come through. Because what we did see is a huge amount of first home buyers wanting to enter the market. But the lending levels were astronomically high, and these first home buyers having to borrow $800,000-900,000 to get into the market. That's scaring a few people, and the regulators are watching that quite closely and putting pressures on banks to really ensure their lending standards are very high. So when our stamp duty changes, I actually don't see a huge amount of impact to our industry.
Yeah, about in the UK at the moment, about 20% of the market are first-time buyers. What's that equivalent figure in Australia at the moment?
Yeah, it's slightly high. It went up to about 28% throughout these particular initiatives. It's come back since those initiatives have ceased. It's sort of back down to the 20-25% level. It hovers around that particular period there. What we have seen come back in the last 3 months is the investor appetite. The investors are really coming back, roaring into it. They sort of went away through through the midst of the pandemic, understandably so. They're sat on the sidelines. But whilst our interest rates remain very low, our jobless rates remain somewhat stable. The investors are piling back in the market, and typically that comes at the expense of first home buyers. So that is the challenge again. The first home buyers are sort of being blocked out of the market, and we've got rental shortages as well. So we've got a real supply issue in Australia. I don't know what it's like in other countries. We're gross undersupply of housing, which is what propped up our prices for the best part of 20 years. Well, I think what will be interesting for Australia is, due to the lockdown and obviously pandemic, population growth will decline, if not just it will stall at least, because we're a country that relies on net migration. And whilst that stops, this could be the opportunity for our government to correct the balance of supply, because they've been frantically trying to catch up for that for the best part of 20 years and unsuccessfully. So the next few years could be the opportunity to balance that off and start to pull down those prices, because this year alone we've had prices go up circa 20%. Which defies belief in the midst of a global pandemic.
Yeah, I mean, we've got the same issue in the UK about supply, housing supply. And I was in the last presentation, I didn't realise that 38% of our housing stock is older than 1946. Which even I wasn't born back in 1946. And so the pressures on the government there to do something here. We, of course, in the UK have got a very small island and not very. And we're again on the brown zones and the green zones. And I think it's a bit of a misnomer in Australia that there's plenty of space to build on, because it's the bits around the edges are useful, but there's a great big chunk in the middle which is only useful for kangaroos, isn't it?
That's right. It's a good point you raised. A lot of international observers missed that point. So I was glad that you have seen that. We not as much livable land as we'd like to have. But what has changed? What's interesting? A lot of international commentators look at the Sydney property market and continue to say it cannot sustain this levels. But what they don't realise is that we've got an ocean to the east, we've got mountains to the west, and national parks north and south. So we're fundamentally landlocked. So that creates that supply issue. There's only so much land available in Sydney, and then much can be said for other capital cities as well. What has changed with the pandemic is that push towards regional centres, where people being locked down are starting to realise that, hey, I can do my job from anywhere really. So we've seen a real increase in the regional cities. So, and that's encouraging, because that's the only thing that could really stop these prices going through the roof. So we're seeing some of our major regional centres have record price growth, circa 30% over the last 12 months. That's started to soften a little bit. So that some of that people relocating for a sea change or a tree change has softened a little bit. But we do expect that to continue. What's the unknown is what are our major employers going to accept post-lockdown? Are they going to allow these remote working to continue? And that's still to be understood. Everyone's sort of waiting on their hands. And to be honest, watching the US and the UK is to see how those companies trade out of it. But that's, we've seen, I'm not sure if you heard of Byron Bay, but, a particular regional city in Byron Bay, which is the south of our Queensland border, price has gone up 45% in the last 12 months. which is just crazy. And there's plenty of other examples like that as well.
Yeah. I think we've on each of the territories, we agreed that the governments have done a pretty good job. I'm going to flip that question a little bit now, but what have they missed? Right, so they've been effective and they've been inclusive, but and I'll let anybody jump in. And don't stick to your own territories. What have the governments missed? What more could they have done?
I think I could jump in if no one's going to. What our government did is, as I alluded to before, that they threw money at the problem, but they threw it sort of without a huge amount of rhyme or reason. So a lot of people who got money really didn't need the money. So that's the biggest thing. I think that they'll be paring that back, going, a lot of companies received what we call job keeper. And these companies were having record years and huge profitability. And now it's incumbent on the government to try and get that money back. And really that's out of the goodwill of those particular companies. So I think we all understood that there's no set rules as to how to deploy this money, but there was just a bit, within respect, a bit of a free-for-all. So, the taxation department's really looking at it. And the other thing that our government did is we have superannuation, what the UK knows as a pension scheme, and we have very, arguably one of the best superannuation schemes in the world, where and allowed, for the first time ever, the government allowed borrowers to access their super for the purpose of basically just some short-term cash, or to use that towards buying their property. That was not executed very well at all. And the long-term impacts of people diving into their pension funds or the superannuation funds will not be known for a long time. But we all know that the wealth factor that can impact in 20 or 30 years' time. It's harder for a 25-year-old to know, taking out $20,000 now will have a huge impact in the future, but we know it will. So that long-term effect will be interesting to watch, because they'll be encouraging these young people to put that money back in to make sure they retire comfortably.
I think from a UK perspective, particularly, it's difficult to see what the government could have done in a short space of time. But I do think that when you look at the mortgage and the housing market, they do need to be looking at the regulatory framework and the complexity that's brought to the marketplace. So really what I would like to see is them stepping back and looking at how the regulation on top of regulation has made the market so complicated, from the APRCs and stuff like that, of stepping back and then making that easier certainly for first-time buyers to access the market, not forcing first-time buyers through this complex process of the fact find and the wants and needs. It's all great, but everybody has to go through the same process. It takes such a long time. I don't think that's what the market particularly wants. I understand why the regulator has wanted to do that, but I think we now have an opportunity to step back from some of that and make the process simpler for everybody. Yeah, after all, it's just a large loan.
Yeah, absolutely.
That's all it is. I was going to move on to furlough, actually. Hitton, the furlough scheme's coming to an end very shortly in the UK. What have you seen in terms of, people coming, not through your doors, because they've been coming through your website and over the phone, I guess. But what's the kind of the holistic picture of the furlough scheme look like, and what do you think's going to happen now that's pretty much at an end?
Broadly speaking, the clients that we are dealing with and that are sort of inquiring about mortgages are actually off of the furlough scheme. And we're seeing probably 1 or 2 in 100 clients that we're speaking with that are still on the furlough or have got some level of government support coming in. So it's actually very encouraging, the fact that people are beginning to stand on their own 2 feet, or at least businesses are, which means that the reliance upon the state is reducing. But equally, if we look at the jobless rates, I think if you look at the unemployment rates, they have come down significantly as well. So there is a lot of job opportunities out there. Businesses are hiring, which obviously puts the country in a very good footing, and our economic recovery is certainly on the right track. I guess it comes down to the point that's been made about how much debt have we accumulated as a nation, and how will that be reclaimed back by tax rises? Whether the government choose to do it via economic growth. If it is economic growth, then great, everyone feels a lot more wealthier and richer. It means that the pace at which the recovery can happen and the repayment of the debt would be a lot stronger. But from the furlough perspective, I think it's really encouraging, the fact that there are only aren't that many now clients that we're dealing with that are actually claiming the government state or the benefit.
Yeah, and actually you make a point there about tax rises. I mean, we've very public change in national insurance made by, that's a kind of government intervention I didn't want to see as somebody who runs a business, knowing that I've got to pay an extra 1.5% employers' national insurance from, I don't know the start date, but you know, I certainly factored it across our salary bill, and it was a sum that I was not particularly keen on. That said, that's the way it is. But yeah, I mean, it's...
Yeah, and I would just add for the self-employed, it's more complex, isn't it? Because with these businesses that have had business loans, grants from the government, as lenders are trying to underwrite some of that sort of stuff, what you find is that they've become a lot more complex. Trying to understand somebody's accounts for the last 2 years has got to be a difficult task. It's always been difficult underwriting self-employed loans, but it must be an order of magnitude more complex now.
Well, exactly. And, you know, and Phil and I were talking in the green room before. I know somebody who makes £3,000 a month from Instagram and YouTube from downing drinks really quickly. You know, so how do you credit score somebody who does that? Now, this is the perverse world we live in, where people make their money in slightly facetious comment, but they make their money in weird and wonderful ways. And you know, and that's, I mean, you must be, I mean, down in Australia, Darren, you must see all sorts of strange requests coming through the Mortgage Advice Bureau doors down there.
That's a good. I'd definitely lend that person my money. That's a great skill to have. Yeah, we actually just, funny enough, you mentioned that today. One of our major banks just announced the first sign of some common sense approach by saying that they will actually start to assess some of these self-employed or these small businesses on the prior year's financials. So in effect, essentially just blanking out the last 12 months to say that how do you possibly fathom what they're going to be going through in the future? So that was a first real sign. And one thing, potentially the same in the UK, I think your big 6 banks, we're going to have big 4 banks. If one bank does it, the other 3 follow pretty quickly. So that's a really encouraging sign, because that's been the great unknown, is that how do these people possibly demonstrate profitability? And obviously the biggest thing that's going to get us out of this is the free flowing of capital to help these people grow their businesses post-lockdown, because just who would have thought, Melbourne, as it stands right now, has been the most locked down city in the world. For a country that has fundamentally survived the pandemic very well compared to everybody else, we're still the most locked down city. So there's a huge pent up demand. So these small businesses need to have some good flow of capital to open their doors and grow their businesses. It's a bit unknown as to how lenders are seeing it. And I think what you said before, what has been challenging for us over the last 12 months is being in the broking lending space has never been more challenging. What the banks have scrutinised everything to the nth degree, made just basic applications incredibly challenging. And if I'm being honest, it hasn't been very fun to be part of the industry, because there's no such thing as what we call a vanilla loan now. Even just a straight simple refinance for a mum and dad PAYG customer, they are just complex now, and that has to change. That at the moment it's tolerable whilst we're in lockdown, but once that demand and the doors open, the lenders need to come to the party here. Otherwise, we will have a fairly sizable problem in the next 3 to 6 months.
And then, I mean, you make the point there, Darren, about you've got the large 5-6 lenders in Australia. We've got the same issue in the UK. The dominance of those 5 or 6 with 80% of the mortgage market, maybe more, 85%. Maybe anti-money laundering might be part of it. But some of the reasons why the rules are so tight, or the criteria that they're looking for, are becoming more difficult. Just on that point of the dominance of the big 5 or 6, are there any further consequences we could expect? In the UK, we think there's probably 40 billion of lending this year going to be spread across 130 mortgage lenders. That doesn't feel to me like the supply-demand equilibrium is right there. What are we going to see with that group of lenders, Phil?
For me, the big lenders, following on from retail bank separation, are all focused on mortgage revenue, and hence we've seen some of the price war. The challenge that they will have, though, is that traditionally they've wanted the vanilla section of the market, as Darren was just talking about, which is rapidly disappearing. So they will certainly have the appetite to take as big a slice of that market as they can, but whether they've got the processes and systems to support that without significantly increasing sort of headcount and manual efforts and manual workarounds, I don't know. And I think we could end up in the situation that Darren talked about there of a big backlog of these complex cases.
Hitton, your view on that? I mean, would you be sending complex cases to the big 5 or 6 now, or do you still see the specialist lenders as the home for that?
From a plain vanilla perspective, clients, PAYE, relatively straightforward clients. Yeah, the mainstream banks are absolutely geared up for that, and of course they've got the best available rates. But anything that touches on the realms of self-employed, they're just not getting it. I mean, it's funny because you can have an employee of that company applying to a mainstream bank, getting lending an offer out within a couple of weeks, but you can get the owner of that particular business applying to that same lender, and God help you if you can get lending through for them in that same period of time, and it has to go specialist. And that's the issue of it, you see. Banks, what we found, the mainstream lenders aren't necessarily training their underwriting staff to understand financial accounts, understand what going concern is, understand liquidity. They're looking at the bottom line, say, well, they've received government grants, JRSA grants, and therefore their business is effectively struggling, hence the reason why they're taking the government support. Well, that's not the case. And I think that sort of binary approach that a lot of the lenders, mainstream lenders, have taken from an underwriting perspective for self-employed clients is causing big issues. So do we have the trust in using the mainstream lenders for self-employed complex clients? I don't think we do. It's more about the specialist lenders who can take a granular approach to those accounts, understand and have discussions with the advisors so they can work together to get a proper outcome is where we're heading. And a lot of our sort of complex cases are going with specialist lenders who are prepared to listen to the brokers and have that dialogue with us to get to the bottom and get to the right outcome for the applicant ultimately.
Yeah. I'm just going to bring in liquidity here as well, and then link this back to 2007, 8, 9, and the credit and banking crises. There was already an oversupply of money in the global economy before the pandemic. And that problem has now been exacerbated, and we know that's for both funding mortgages, and we've talked about that. There's also, I think, in private equity funds across the globe, there's $2 trillion of what they call dry powder sitting there, waiting to start new mortgage lenders, certainly in the UK. And I've heard just this last week of the US banks looking towards the UK again, even though it seems to me there's an oversupply of lenders. I'm not unhappy because that's good for us. What's I think Tony Ward of Fortress gave a presentation at our Lending Summit a couple of years ago, talking then about the unwinding of the government bonds and bringing some of that money back in. That never happened. So this money's out there plus the COVID money. What's the impact of that oversupply of money, both on the residential mortgage lending, but also on the number of mortgage lenders in the market? And I'll throw that to Phil first. And that's a big question because we're thinking UK, Belgium, and Holland here.
Yeah, very, very, very quick answer for me on that is you can only see further pressure on price and further pressure on margins, which then means to relieve that pressure on margins, lenders are going to have to go into more complex cases. I won't say more credit risky cases, but certainly more complex cases. The self-employed market is increasing. More and more people are self-employed. More and more people have got multiple employments. There's got to be lenders who are going further into that market to try and get margin.
Yeah. I'll come to Darren or Hitton here. Do brokers or consumers need more lenders? I mean, there's enough? I mean, what's the number of mortgage products out there at the moment? I think we saw earlier there's 698 equity release products in the UK alone, just in equity release. Do we need more choice?
I mean, I guess there's enough choice out there currently, but I guess you can always have more options available, because I think that the unique set of circumstances that every client tends to have these days means that just by knowing that there are options, I mean, last year as a firm, we probably used a spread of 57 different mortgage lenders. So the fact that, you know, there is a lender for a particular customer, and the fact that you've got more choices is definitely a good thing for the end user. I think the comparison for 2008 and the issues that we had there, I think that the banking regulations back then were a lot looser. I mean, I remember sort of Northern Rock, who were one of the first banks to go under back in 2008, were offering lending of 120% of the value of the property. There was less fundamentals to support the house prices back in 2007, 2008. So there was a number of factors that effectively resulted in the crash that we had back then. I think if we sort of look forward, the fundamentals, the liquidity ratios, the regulatory influences that have taken place, I think all of those sort of free-for-all activities have actually been curtailed to a certain degree. Of course, it still requires regulation because there will be people that are trying to take advantage of the market out there. But I think we're on so much more stronger footing. And I think that, you know, just by having more choice, more variety for our clients, I think can only be a good thing.
Hitton, that's a great number, actually. You said you used 57 mortgage lenders. Was that in the last month?
No, sorry, that was in 2020. We used a spread of 57 different mortgage lenders. Do
you tell your clients that? Because that's, you know, because I'd imagine that would be a great figure to tell your clients, to say, look, out of 140 odd mortgage lenders in the UK, we're using, I don't know what the percentage is there, about 40%. That's, you know, that demonstrates your commitment to impartial advice, which I think is tremendous. Absolutely. And I think what we do say to our clients is there isn't a mortgage option that's not out there for you. It just depends on the price, and that will be determined by your circumstances. So there is always going to be an option out there for a client. And as I said, you know, it's just good to have a variety. And of course, the more competition that comes into the market means that ultimately it'll have an impact on the price, and it means that those sort of high risk sort of clients who have got credit blemishes, etc., where they're paying high rates of interest, we could potentially look to bring their rates down by there being more competition in the marketplace. So it can only be, as I said, a good thing. Cool. Okay, we've got about a minute and a half left. I'm just going to link it directly back to the credit and banking crises. Any differences, do we think, to dealing with the current pandemic to back then? I know we're going back into the dim and distant past.
For me anyway, I mean, the credit crisis then was more about funding in the marketplace. I think this has been a lot more around a personal circumstance, people working from home, people having a reduction in income, etc. And of course, with the banks not being able to process those applications, I believe there was demand in the marketplace, but a lot of the lenders closed down because they hadn't got the staff to process the applications. So yes, quite a significant difference for me.
But Darren, you said Australia didn't get away with the 2008 crisis, but nowhere near the severity of the impact.
Nowhere near it. Yeah, we watched obviously the rest of the world. I think, yeah, notwithstanding liquidity constraints throughout that period, there's no doubt that was a challenge that we all face in the banking sector. But I think what we've seen, obviously, this is not a liquidity issue, as you allude to. There's a lot of capital sitting on the sidelines ready to be deployed. So what the big difference that we saw with 2008 is, I think, just our government was used as a blueprint to be brave. I think they were unwilling participants to be brave in 2008. They sort of didn't know what they needed to do, and they sort of did a little incremental steps. What they did learn is that the power of some of those decisions that they can make, they threw the book at it, and that stopped the bleeding pretty quickly. And I think that's one big difference from the Australian perspective. So whether that holds us in good stead moving forward, time will tell. But we had the ability to do it, and we had a government that was not afraid to do it.
Yeah, I mean, there's been no question about lenders disappearing this time around. I remember the managing director for one of the very, very large, won't name them, high street mortgage lenders at the time, saying to me, Luke, even we will be affected. Anyway, that lender was rescued by another lender, and within a few short months, and you know, to see lenders of that scale disappear was seismic. Our business at the time, we published into the mortgage market. It's a different business now, but revenues in a year fell by 90% and profit fell by 97.5%. Employees went from 65 to 6. It's quite a staggering change. But I think we're pretty much out of time. But so I think that just leaves me to thank everybody for their contributions. So Hiten, thank you very much for joining us. Darren, thank you for joining us. I didn't ask if you are actually in Australia, Darren. Are you in Australia now?
I am. I'm in Sydney. I'm in lockdown for however many long to go. So we have our version of your Freedom Day in a couple of weeks. I believe.
Yeah, hopefully that goes well for you, and I hopefully there's still something left on Netflix you haven't watched. But unfortunately, the Ashes hasn't started yet, so we can't really talk about that. But we can maybe, forward to it. Yeah, we'll talk about that next time. And Phil, thank you so much for joining us in the studio, and delighted to see Ohpen in the UK now, helping lenders and brokers in time as well with their mortgage journeys. I'm sure you guys will make a great impact. So thank you very much.